and thanks for joining us for today's Monitor Explained webinar, taking a deeper dive into the third issue of Monitor 2024, our quarterly report that gives you an up-to-date view of current non-energy costs. Just a bit of housekeeping on the webinar. This session is being recorded, so it can be shared with you after, and for anyone who couldn't join live to watch on demand. If you have a question, please submit it in the Q&A function throughout. And at the end of the presentations, there'll be sort of an allocated time where I'll run through these with the experts that have joined us today. I guess any unanswered questions today we can take away after the session. So if you're a customer and you haven't got your copy of the Monitor report just yet, you can contact your account manager for a copy, or access this helpful guide by logging in or signing up to EDF's Market Insight portal with the address displayed on screen at the moment. The Market Insight portal is your kind of gateway to regular updates, and it's there to help you make the right decisions for the business and have access to quality data and expert analysis to help you navigate in a complex commodity market. So just a bit of an introduction. I'm Suneet Sofat, Senior Account Manager at EDF, and I'll be hosting this session today. Joining me are some technical experts from the Wholesale Market Services team. David Edmonds, Senior Manager of Retail Services, Dan Wilkinson, and Dan Minifie, Senior Analyst and the Retail Services and Cost Stack team. David, perhaps you'd like to start with a quick overview of what we're going to be discussing today?
Sure, thanks, Suneet. So I think we'll cover similar topics to some previous webinars this time again. So we'll have another overview of where the latest is on April 24 charges, and also just a quick reference head to April 25 as well. We'll then cover Besuos in some more detail of what's been happening there with some recent announcements, and then also look at CFD and in particular the allocation round 6 results that came out last week. And a bit of an overview of what we know so far about the RAB funding mechanism that sits alongside the CFD scheme. So to start off, we'll do a bit of an overview of April 24 charges. Now, the reason we've done this in the last couple of webinars is because we give quite a wide range on some of the costs in the Monitor report, but we're aware it can be helpful for people who are trying to set their budgets to understand where within that range we think the most likely outcome might be, while still acknowledging that there are significant risks against some of those more central views, which is why we show the range on the outcome. As we go through the charging year from April to March, we get more certainty over where some of these costs will outturn. Sometimes that's because rates will be set and published in advance, and other times it's because we get more outturn data as the costs actually materialise and if they're billed to suppliers as we go through the year. Start off with Besuos. Has actually been very little change in terms of the high-low range and where we think the most likely outcome is on this one. And I won't cover that in too much detail now because Dan Wilkinson will go through that as the next agenda item. Moving down to the CFD, the Contract for Difference charge. We've got a slightly narrower range on this one this time, and that's because we have got 3 more months worth of outturn data that's come through. The outturn costs have been broadly in line with our forecast. We've not seen massive wholesale price movements, and prompt wholesale prices have outturned pretty close to where forward prices were. So that's meant that the cost has been outturning as expected. And that's why the low range has come up a bit and the high range has come down a little bit. In terms of the best view of where we think that cost will outturn for the year as a whole, it is closer to the high range and the high rate of the range. And the reason for that is because one of the key drivers of the CFD level is where wholesale market prices are, and in particular the day ahead price is. The higher the day ahead price goes, the lower the CFD rate is, and it can even become negative. And the lower the day ahead prices are, the higher the CFD rate goes. Now, wholesale prices have fallen a lot over the last 18 months or so. So they are already at reasonably low levels compared to the range of outcomes we could see. And so what that means is there is more potential for prices to increase by a lot than decrease by a lot. There's a bit of a floor really to where wholesale prices are likely to go on a regular basis. And we're not masses above that floor. We are above the floor, but not masses. So that means that if prices did outturn a little bit lower, we could see higher CFD rates come through. But if prices were to go a lot higher, we could see a big decrease in the CFD rate. And that's why the range does go much lower than it goes higher compared to our best view at the moment. Next one down to capacity market supplier charge. This one is fairly symmetrical and hasn't changed massively since last time we shared this view. Key outcomes that we're waiting to see really is chargeable demand across the winter. So because the capacity market charge is only on consumed volume between 4 till 7 p.m. on working days of November to February, we don't yet know what that demand will be. We have a forecast of what it will be, and the range of that forecast is the main driver of why there's a range in the outturn capacity market costs. But it does depend on where the national consumption is at that time. There is also a possibility that some generators who we are expecting to get paid through the scheme may not meet the requirements of being available, and so there could be a bit of a decrease in costs that come through there. But that's normally a fairly small movement on that. So that's why I say it's a fairly symmetrical view, and the middle of the range is probably the best place to place a forecast for that one. GEOS rates, it's a quick one, so they're already fixed. They were fixed for April 24 back at the end of 2022. So we know what those are already, and they shouldn't move around. So moving down to FIT, so feed-in tariff costs. Again, this one is a fairly symmetrical upside and downside risk. So we would suggest that the middle of the range is the best place to forecast that one. Key variables for it are solar generation and then also a bit of wind generation, because that's the main generation type that's getting paid through this scheme. The ranges have come down a little bit, and the reason for that is we've seen outturn data for Q2 of 2024, and what we saw across that quarter was fairly low solar generation, and that meant that there were lower payments to be made through the FIT scheme and lower charges to come through to suppliers and consumers. So that has actually come down a little bit since the previous report, which is good news. But still a reasonably wide range depending on the weather we have over the remaining 3 quarters that are still to outturn of the year. Then RO, it's one of the bigger changes in terms of the high range that we've seen here. Now the main risk that we've got is mutualisation, but you'll see we're showing the same view for low and high rates on the RO. And the reason for that is we think that although it is technically still possible that it could happen, the risk of mutualisation happening, which is where suppliers exit the market before they've paid their RO bill, is much lower than it used to be, and sort of not really within a reasonable range of forecast that we're trying to provide. So it could happen, it still could happen. We just think it is very unlikely to happen, and are therefore showing the rate as the published rate ahead of the year of what would be charged rather than building that in. The reason that we have taken that risk out and what's changed is that suppliers are required to hold back capital in order to make sure they can pay that bill. So if a supplier was to exit the market, there should in theory be the capital there to pay that, which should mean that other suppliers and consumers don't need to pick up the bill as a result. And finally on here is TNUoS, which again, similar to GEOS, rates were set. So they were set at the end of January this year. So they are known for the April 24 year, and we don't expect those to change as a result. That's all for April 24. I guess just a quick nod to April 25, although I think from the next webinar, we'll probably start to show some of those numbers in a bit more detail as budgets will move into that period. But I guess most of the view is kind of fairly similar to April 24, but I'll just highlight some key changes as we go through. The main one would be that there is a wider range of outcomes for April 25 because less is known about the year. There's obviously no outturn data yet, and other things still to be confirmed mean that there's more uncertainty. In general, for how we expect the cost to evolve, we'd expect BSUOS to be a bit higher. than it is for April 24. So that's one that you expect to increase, which you can see in the reports if you look through the individual pages. CFD probably a little bit higher, but certainly a much wider range because wholesale prices could move much more before we actually get to that outturning. Capacity market is quite a lot higher, and the reason for that is recent auctions have cleared it with large capacities of being procured and at fairly high clearing prices. So that is driving more costs. So for the next few years, that ramps up quite quickly. And it's also quite a wide range of outcomes where some of the auctions are yet to happen. So there's an auction that happens 1 year ahead of delivery for each winter. That will happen in March of next year. So after that's happened, that range will become a bit narrower for the April 25 charges. GEOS rates are also already fixed for April 25, so they should be known already. So that is the same as April 24. And then FIT and RO are both schemes that have closed. So they stay at a reasonably flat level. They do increase a little bit with inflation, and also potentially if any decreases in chargeable demand, if there's less demand to share the cost over. But there is a wide range of outcomes there until things get confirmed, particularly through renewable generation levels. TNUoS is then also one which does increase. So we've spoken about that in the last couple of reports and the last couple of webinars. So that there is quite a marked increase in TNUoS as we go into April 25 year as well. But those rates will be confirmed in January.
Thanks, David. Yeah, very useful. And just touching on the note on April 25 and looking forward, are there any particular kind of rates that people need to keep an eye on?
Yeah, so I guess one that will change fairly quickly in terms of certainty is RO, the renewable obligation. The reason for that is at the end of September, we should get the obligation level confirmed by the government of where that will be. That doesn't give us complete certainty, but it's by far the biggest variable on what that charge will be. So by the time we come to the next quarterly report of this, it should be a much narrower range for the April 25 year. Depending on what the outcome is, it could be higher or lower than we're currently showing, but we should know a lot more at least by then. And then probably the other two, as ever, to keep an eye on are CFD and BSUOS, of where they're often tracked with wholesale prices quite a bit. They can be fairly volatile and move around quite a lot. So they're definitely ones to keep an eye on and be a bit cautious when budgeting for those.
All clear and makes sense. Yeah, thanks, David. Appreciate that. Dan Wilkinson, I think you're talking us through some of the recent news on BSUOS costs for the future years.
Yes, I am indeed. So a couple of bits of news mostly for the April 25 year that we'll touch on, but also a little bit that relates to that range that David shared on the April 24 table for BSUOS, with a little bit of insight from recent outturn. But the first bit to cover is that in June, National Grid published a final tariff for the summer 25 season. So they published that at 10.74, which is a final rate. We'll touch on whether that's kind of fully fixed or could be opened number in a minute. They then also published at the same time an indicative forecast for winter 25, and they published that at £11.99 per megawatt hour. So those are the two new bits of information we've had. That summer rate of 10.74, that includes a view from National Grid that they expect to over-recover during the current summer we're in, so summer 24. And at the time of setting that rate, they took a view that over-recovery would potentially be at around £215 million for the summer. Now, we've been tracking outturn BSUOS costs, because behind those final rates, National Grid are still incurring variable BSUOS costs that they have to manage while managing the system. And what we can see is it's in that chart at the bottom. We can see as we track throughout summer 24, effectively we had over recovery, which is that yellow line, and we can kind of track how that had built up over the season. It was building up to a very steady steady rate, up to around a peak of about 150 million ahead of August. However, we saw August be a extremely expensive month for National Grid when balancing the system. So we saw August outturn, we estimate to be around £17 per megawatt hour, which as a rate is one of the highest rates we've seen for Busuos cost to materialise. So that has significantly brought down the over recovery that National Grid have to date for this summer. So over recovery at the minute we estimate to be around 58 million. And obviously we can compare that back to that 215 million that they've budgeted to go into the summer 25 rate. That expectation, that's at the minute falling quite a long way short of that. So that will kind of potentially have knock-on effects when we get to those later seasons, depending where Busuos costs outturn, because as we can see from August and other months across the last season or so, costs are still very variable and can get to very high levels. So what's the risk there then on some of the fixed tariffs, and why have we still got the 2024 number with a range on, even though the summer 24 and winter 24 numbers are published from Grid? Well, if under recovery through recovery from Busuos is high enough, so costs are way higher than the tariffs that they fixed over a certain period of time and get to a sufficient level, then National Grid can reopen their tariffs and recover from suppliers additional costs that they've incurred. We think for summer 24, at the minute, that over recovery is £58 million. That's a sufficient buffer towards the end of the season with only 1 month left to mean that they're unlikely to ever get to those levels of needing to reopen summer 24. But for winter 24, we obviously don't know any data yet, and there could be, depending on prices and balancing actions required over the winter, hopefully things will be stable. But if things are similar to August, then there's a risk that some of those tariffs could be reopened by National Grid. But at the minute, we have a final tariff for winter 24, and now we have a final tariff for summer 25, published by Grid. That is the update for Busuos from myself.
Thanks, Dan. Appreciate that. And Dan Murphy, you think you're going to be talking through the recent updates on CFD?
Yeah, I can give an update on CFD. So the main update really is AR6, the 6th allocation rounds, which results have been published on 3rd of September. So we've seen a total of 9.6 gigawatts of capacity, over 131 projects being awarded contracts, and that's more capacity than any previous CFD allocation round. That's probably some of the big news items from that are that we've seen a return of offshore wind after the previous AR5 allocation round where no offshore wind was successful. That's largely thanks to the higher administrative strike prices that was set. So we've seen about 3.4 gigawatts of offshore wind in the 2028 delivery year, and that's basically composed of 2 projects, Hornsea 4 and East Anglia 2. Also an additional 1.6 gigawatts in the 2027 delivery year through what is called the permitted reduction offshore wind projects, and these are essentially projects from previous allocation rounds that could withdraw up to 25% of their capacity and re-enter in future auctions. So some of the projects here have included Inch Cape, Moray West, East Anglia 3 and Hornsea Project 3. Additionally, we've seen significant amount of solar PV, so over 3 gigawatts of solar across the 2026 and 2027 delivery years, and about 1 gigawatt of onshore wind, also across 26 and 27 delivery years. Some substantial amounts of floating offshore wind as well have been awarded contracts. So, coming from one project called Green Volt in 2028 delivery year, with a high strike price of about £195 per megawatt hour in once converted to current 2024 prices. As we can see on the right hand side of the charts, which have been sourced from Low Carbon Contracts Company, these are showing the expected total CFD capacity over the entire portfolio over each year. The top one showing this, breaking this down by allocation round, and the bottom one by technology. We see there could be a substantial increase in CFD capacity from the 9 gigawatts that we currently have online today up to around 37 gigawatts or so by the end of the decade, with nearly 10 gigawatts of that coming from AR6. This does assume no delays or terminations, which may be a big if, but either way, we're expecting significant new CFD capacity to start over the next few years. Today, offshore wind is by far the most dominant technology, making up about 7 gigawatts of the 9 gigawatts that's online currently. By the end of a decade, offshore wind will still be dominant technology, but potentially with a much lower proportion due to the significant increases in solar, which would increase from 20 megawatts today up to around potentially 7 gigawatts by the end of the decade, but also significant increases in onshore wind and nuclear, with HPC expected to start around 2029. In terms of the CFD consumer costs, while we do expect this to rise a little bit over the next few years, we don't expect to see the same big proportional increases as we see with these capacity increases. And this is largely explained by the chart in the bottom left, which is showing the capacity weighted average strike price by allocation round. And these are in 2012 prices. Again, this is sourced by the Low Carbon Contracts Company. As we see, the most expensive projects here basically are the early contracts from the investment contracts in AR1, and to some extent the bespoke contract for HPC. But since AR2, the strike prices have come down drastically, and then sort of fall into a sort of a floor around AR3 and AR4 before coming up a little bit again in AR5 and AR6. And AR6 is quite close to AR2 in the end, but these strike prices from AR2 onwards are much closer to the current and forward views of wholesale market prices. So we don't expect these to add significant extra costs to the scheme, and in some cases, the lowest strike price projects may be paying back into the scheme, which should help reduce some of the consumer costs. So yeah, going back to the AR6 results in the table, we can see offshore wind strike price has cleared at £82 per megawatt hour. This is after inflating up to the current 2024 prices, and also permitted reduction offshore wind at £75 per megawatt hour. Solar and onshore wind both around £70 per megawatt hour. So these are kind of similar levels to current forward views of market prices. We also have floating offshore wind at much higher strike price of £195 per megawatt hour, and tidal stream at nearly £240. So these would be receiving large top-up payments, but however, the capacities of these are much smaller compared to the other technologies. So it's kind of, they should be outweighed really by the other technologies and not add too much additional cost. So yeah, we're still analysing results from AR6, but our initial kind of view is that it's not going to cause a significant increase to the costs based on the latest forward prices. However, this does depend on any changes to wholesale markets in the future. If prices come down to more sort of historic levels, this will lead to higher CFD costs. And then on the other hand, if prices go up again, as we saw during the energy crisis, we could see a return of negative CFD prices.
Thanks, Dan. Yeah, really insightful. I guess just off the back of that, is there any update on the nuclear RAB scheme? What do we know kind of so far on that?
Yeah, sure. So nuclear RAB scheme is a new scheme designated to designed to support new nuclear, and it's initially been designed for Sizewell C. It's technically a separate scheme to the CFD. However, there are a number of similarities with the CFD structure, and also Low Carbon Contracts Company, or LCCC, have been designated the scheme counterparty, like the CFD scheme as well. So there are some similarities, but it is technically separate. So I think what we do know so far about the nuclear RAB scheme, or regulated asset base, is government has designated Sizewell C as the first project to use it. Ofgem will set an allowed revenue for nuclear plants on an annual basis by 1st of February each year. I say nuclear plant because although this has been designed for Sizewell C now, it could potentially be used again in the future for other new nuclear plants. During the construction phase of the project, the nuclear plant will receive that full allowed revenue. So they will receive payments during construction, which is different to the CFD, where they only receive payments once they actually start generating. Then during the operational phase, the nuclear plant will sell electricity into the wholesale market and generate seasonal market revenue. Then there would be a difference payment from that market revenue to the allowed revenue, and that could be a positive or negative payment. Again, similar to the CFD, where you can have those positive or negative payments to the strike price. But obviously for Sizewell C, that operational phase is still a long way from now. So for now, it's really looking at that construction phase and the allowed revenue which they would receive. Yeah, in terms of, I guess, sort of what's coming up in the short term for RAB. So in an earlier webinar with LCCC and DESNZ back in, I think, May time this year, they said by the end of 2024, there was a target for the final investment decision, or the FID, for Sizewell C, and therefore commencement of the revenue collection subject to approvals. It's possible, though, with the general election having taken place, that could be delayed, that timeline. We're not sure yet. Once that FID has been confirmed and Ofgem set the allowed revenue, the LCCC would then set a quarterly interim levy rate and a total reserve amount, which would be charged to suppliers with 30 days notice. There would be an initial levy which would be triggered by Ofgem following the announcement of the final investment decision. The ILR, or the interim levy rate, during the construction phase, that would be calculated from the allowed revenue, and then also national gross demand as well, to convert that into a pound per megawatt hour rate. And EIIs will be exempt from that, similar to the CFD scheme. I suppose what we don't know, fortunately, are the expected costs and the exact commencement date of that first levy rate. DESNZ have committed to providing a forecast view of that. However, they haven't committed to a date, so we're not sure when that will come. And additionally, the allowed revenue, the detailed calculation methodology behind that isn't really known yet either. So yes, still a lot of unknowns, which isn't ideal because it could start soon without much notice and without much insight into the magnitude of that cost. But yeah, it's possible we could know more by the next Monitor webinar, and particularly if that FID is announced. And when we do know more, we can provide a further update on that.
Brilliant. Thanks, Dan. And I think we might have actually covered one of the questions within the Q&A chat as well, which is great. I guess that's great. I mean, thanks all. I think that brings us to the end of the kind of the prepared content, but we've obviously got time for questions that obviously you can keep putting into the Q&A function. like I mentioned, we have had a few in already. I think one of the ones was I think David on the non-energy costs for budget costs. Could you explain how these rates were applied to the overall consumption for a site at megawatt hour?
Yeah, so of the numbers that we were showing in the table there, they're all multiplied by the megawatt hour volume of consumption. One of the slight differences to that is the capacity market charge, which is only to consumption between 4 and 7 p.m. working days, November to February. In terms of the two that we didn't show rates against, Duos and Tenuos, they are a bit mixed in terms of what they're recovered. So Tenuos is mostly recovered as a pound per site per day charge. All the residual costs are through that, and they make up the majority of Tenuos charges. Although there is some other elements that are slightly different for non-half hourly and half hourly sites. So non-half hourly is charged on 4 till 7 p.m. consumption year round. But again, very, very small rates typically and vary around the country for those. And half hourly sites are still charged based on the triad methodology of the capacity that was being utilized during the 3 highest half hours of national demand across a winter. But again, also pretty small elements of the Tenuos charge on that. And then Duos is a real mixture of different methodologies. Some are volumetric and based on the consumption, but at different times of day on a red, amber, green structure of high rate, medium rate, and low rate. Some are on a pound per site basis. Some are capacity charges. Some are other fixed pound per site charges. So lots of different elements to the Duos charging. But the ones we showed, which make up the majority of the cost base, are based on a megawatt hours consumed.
Thanks, David. And then has there been, I think this one is on EII subsidies. Has there been any more news on how the EII subsidies will be charged?
Yeah, I think I can take this one. So on the EII, so I guess there's two main parts of the EII. The first is an increase of the existing EII exemptions for certain policy costs, including RO, CFD, and FIT, which we've briefly covered before in the CFD talk. So that has, those costs have seen an increase of the exemption from 85% to 100%. And additionally, capacity market costs are now 100% exempt from EIIs, whereas previously there was no exemption for capacity market. That has already gone ahead as of 1st of April this year. The second part of that is the compensation of network costs, so Duos, Tenuos, and Basuos of EIIs, so that they will be able to claim back compensation for 60% of their network costs. And this is known as the Network Charging Compensation Scheme. Elexon have been appointed as the scheme administrator for that. And how that will work is that the EIIs will pay the network costs up front, but receive compensation for 60% of those costs about a year afterwards. So their costs from April 24 onwards will be compensated to them, I think, from July 2025, and that will be funded through what we call the EII support levy, which will be based on the supplier's market share from the previous year. So, for example, the supplier's share from April 2024, but only collected from April 2025 onwards. Yeah, I think that covers the EII updates.
I guess I've just seen a question that's come through as well, I think, on the market-wide half-hourly settlements costs as well. So just as a two-part question, let's just finish that off. I think I believe they are all built into Elexon's budget, so it's not a cost item we normally talk about on these webinars. It's a much smaller cost item, but they should be factored in, albeit the Elexon's budget can get changed at reasonably short notice before each charging year. So we use their forecast of what they expect to be recovering from suppliers. and build that into quotes and bills as we have it.
Brilliant. Thanks, David. And I guess just given the recent kind of we've got another one here, given a recent kind of reversal by the new government for onshore wind generation, as well as their keenness for renewables, can we expect to see non-energy costs increases begin to slow down? And if so, when would they be? I think there's coupled with a question that's in the chat as well.
Yeah. So I guess first thing to say on that is probably that there was a webinar, I think it was last month, that was done by our corporate affairs team on the new government energy policies. So I'd encourage you to check that out via the Talk Power website if you're interested in a bit more detail about the new government and what that means. I suppose also maybe just before I answer the question more directly, worth reflecting on what's driven a lot of the increase in recent years into some of the costs. So the inflation that we saw, particularly across 2022 and 2023, indexes into a lot of the costs, the non-energy costs that come through. So in terms of rapid increases, that's been quite a key driver. And obviously inflation has now settled down to a more normal rate. So that would slow down. So in terms of the increases coming through to the question. In terms of the other bit, and sort of more specifically the onshore wind, I guess what we've seen in the CFD auction is onshore wind strike prices were a little bit lower, but not massively different to solar and offshore wind. So I don't think there'll be a massive cost difference there. And I think what you need to recognise really from the government policies is where there's this ambition to accelerate net zero. I think that is going to require investments from somewhere, and currently the mechanism would suggest that non-energy costs would be a way to pay for a lot of those costs. So for example, the CFD that we just talked about, the increased AR6 budget, a record budget, and a lot of the commentary that came after that around the industry was that actually even higher budgets might be needed to meet the targets that have been set. So if you want to build lots of renewable generation, money has to come from somewhere to fund it, and the CFD mechanism is a key part of that. If you do then increase renewable capacity, we're also going to have to invest in the networks to be able to get that renewable generation to where people are consuming it. So that would suggest that TNUoS and GEOS costs could also need to go up to fund investment in the networks. And certainly we've seen with some of the recent TNUoS increases that have been announced by National Grid, a lot of those big investments and big infrastructure projects starting to come through as part of energy bills. So yeah, I think it really good to have the ambitious plans for the long term and trying to get this where we need to be with net zero. But there does need to be some investment and financial backing to achieve a lot of those targets, and that may mean increasing non-energy costs in the medium term.
Thanks, David. And just on non-energy costs, capacity market, what do we expect what do you kind of expect the capacity market clearing prices to be next year?
Hi, yeah, I think I can take that one again. So I think it's probably referring to the recent initial auction parameters that have been confirmed for the upcoming T-1 and T-4 auctions for delivery in 25, 26 and 2028, 29 respectively. So for T-1, the target capacity was set at 6.5 gigawatts by National Grid ESO. Well, actually, the grid actually recommended slightly higher at 6.8, but DESNZ, who have to sign it off, felt that was slightly too high and have lowered it to 6.5 gigawatts. Last year's T-1, previous T-1 target was 7.7 gigawatts. That's for delivery in 2024. That cleared at about 36 pounds per kilowatt. So while this year's target is a little bit lower, it's still quite a high level compared to historic levels, and continues a trend of kind of high target capacities of more than 5 gigawatts since the 2022 delivery year, following the energy crisis and heightened security of supply fears. So we've seen these higher target capacities leading to high clearing prices in the last few auctions for T-1. So we expect probably the same again this time round. For the T-4 auction for delivery in 2028, 29, the target capacity was set at 44 gigawatts, with an additional 1 gigawatt set aside for the associated T-1 auction in that delivery year. And that's exactly the same target that was set for the previous T-4 auction last year, which cleared at £65 per kilowatt. So again, we're expecting another tight auction this time round for T-4, particularly with closures of old legacy generators and a reliance on expensive refurbishing or new build plants to help meet that target. So yeah, probably quite high clearing prices again are expected. But yeah, this ultimately, it depends on how much capacity enters into the auction, and also the strategy of individual large generators during the auction itself, which can kind of sway the results significantly. So yeah, I think next steps for capacity market auctions, we will know the final auction parameters in February, and then the auctions will take place in March 2025. So yeah, we'll find out then what happens for sure.
Brilliant. Thanks, Dan. And I think there was one there for Dan Wilkinson. It was just on what specifically led to the circa 100 million pounds of balancing costs in August. I think it was on one of the slides that we touched on.
Yeah, so we noted that August was a particularly high cost month. Over that month, we saw a lot of wind being bid down, and at simultaneous times, gas being offered on. And that's quite a common theme that we often see, but August was a particularly windy month. So that wind up in Scotland, that perhaps isn't necessarily always required up in Scotland, was being bid down and gas offered on. There was a storm over the 22nd, 23rd, Storm Lillian in Scotland, which was one of the highest cost periods over that month. So yeah, it was, as people will have remembered from the weather, it was quite a windy month in itself anyway. So, yeah.
Brilliant. Thanks, Dan. Okay. Not sure if there's any further questions relating to it, but so I guess thanks very much for all your questions, and thank you to, I guess, our presenters for sharing their insights today. And I guess
and there was one more actually, Sunil.
I haven't missed one.
Seen in there. So I think it was when we were looking at the CFD charts, I think it came through. We were saying, does it suggest that typical summer total demand will be met by CFD generation by the end of the next decade? Which is an interesting question. So I think a few things to bear in mind. So total amount of capacity and total amount of generation doesn't necessarily mean it will match up on a half-hourly basis to when demand is. So wind output particularly can be very volatile. You can have periods of very low wind, periods of very high wind, and demand doesn't currently have the ability to flex a huge amount around that. So it's probably unlikely that you'll get sort of significant long-term periods where it is all being met by wind. There'll still be a need for other generation on the system. Also worth bearing in mind that other changes that are coming, and electrification will mean increased demand as well. So we need a lot of this extra generation to meet future higher electricity demand through things like electric vehicles, electrification of heat, and then other things like hydrogen production or data center build out, and those sorts of things that may mean more electricity demand is needed, as well as more generation coming through.
Thanks, David. If there's any more I've missed. The questions. Yeah.
Just scrolling through, I think there was one more on EIIs.
Oh, was it? I have
non-EII customers. So
I have missed one.
The question is how will non-EII customers see the levy applied to recover the costs? And the answer is for the individual cost items that Dan was talking about, where they're increasing from 85% to 100%, those rates will just go up a little bit. There'll be lower chargeable demand to smear the same cost across. For capacity market, that's a bit bigger impact because it's going from 0 to 100%. So that'll be a higher rate on the capacity market for non-EI customers. And then for the network charges, there will be a separate levy, the EII support levy, that will be charged to suppliers and therefore consumers to recover the costs for compensating EIIs for those charges. So essentially a mixture of higher rates on existing charges and one new charge coming in.
Brilliant. Thanks, David. I'm just scrolling through now to make sure I've not missed any more.
I can't see any more.
I think yeah, I was about to say, I think that you've covered them all. So I appreciate that, David. Thank you very much. Yeah, again, thank you to all the presenters today for sharing their insights. It's much appreciated. And I guess take a look at our program of webinars across the year. They're there to keep you informed of kind of the latest power market and NEC updates. You can register to attend any of these by heading over to that link within the slide there and clicking on the Talk Power events page. I guess before we go as well, we'd love to hear your feedback to help us continue to deliver the right content for you in 2024. So if you could give us a minute of your time and click on the link provided within the Q&A chat function to complete a quick survey, we really value the feedback. And finally, if there are any further questions or anything that you may think that you may need to ask, details are there on screen, the Let's Talk Power email address there, and please do get in touch. To stay in touch with all the latest industry news and updates from EDF, please follow our dedicated EDF Business Solutions LinkedIn page, where you'll get kind of all kind of feedback and updates on there. Thanks again for joining, and we'll see you next quarter.
Thanks all.
Thanks a lot.
Cool.
Thank you. Bye.